Good day. My name is Claudia, and I'm joined by Tim, Steve, and Anders. We are Seton Hall University, and we initiate coverage on Merck with a buy recommendation, a price target of $99, a 19% upside as of April 20th. Merck's mission is to save and improve lives around the world, inventing for a better life. Three pillars support our price target: fast-growing oncology drug Keytruda, fast-growing vaccine, Gardasil, and the increasingly successful animal health division. I will discuss the products and corporate governance that provide Merck's competitive advantage. First is Gardasil. Gardasil's 5-year CAGR is a healthy 17%. There is room for growth for this HPV vaccine, as 97% of the world's eligible population has yet to be vaccinated. Next is Keytruda. Since its approval in 2015, Keytruda has dominated the lung cancer space. Its revenues are expected to be $23 billion by year 2025, making it the world's top-selling drug in history. Both drugs are patent protected to year 2028 and have recently surpassed the performance of competitors, including GlaxoSmithKline and Bristol Myers Squibb. Rounding out our holistic story is the animal health division. In this space, we see expanding sales reaching near twice the global rate. This division will only continue to grow as middle-income countries increase demands for antivirus protections. The best is yet to come for Merck. So, what else makes Merck special? Innovative pipeline progression and global expansion into China. With the industry's largest research program, Merck is finding new ways to use Keytruda in combination and in various cancer settings, extending its product lifecycle through optionalities. Merck is also expanding its presence in China, where the most predominant cancer is lung cancer. Over an 18-month period, Merck's sales in China increased 43%, while competitors are lagging behind at 11%. Merck is also committed to ESG. From environmental goals in wind energy and identifying antiviral compounds for the coronavirus outbreak, to leadership and price transparency and well-rounded rankings from outside companies, Merck instills this commitment from concepts to practice. In addition, Merck's executive pay is in line with peers while maintaining a non-staggered board. Merck is committed to serving the global community. This is our holistic story, and now I present Tim with our financial story.
Thank you, Claudia. The income statement tells a story of revenue growth, margin expansion, and earnings per share growth. This is a result of the successful execution of its innovation strategy. Revenues in 2018 were $42.3 billion, up 5% from the prior year. And in 2019, revenues were $46.9 billion, up 11% from the prior year. This growth is driven by all three pillars, especially the oncology pillar with Keytruda. And we forecast revenues to be $50.2 billion for 2020. Now, since 2014, gross margins, operating margins, and net margins have trended upward and are an impressive 70, 26, and 21% respectively, as cost cutting is boosting earnings per share. Common size income statement reveals a 10% reduction in total costs since 2016. There is manufacturing restructuring and AI advancements that should further reduce costs by $1.2 billion by 2022, pivoting Merck as the undisputed leader in oncology. This has led us to forecast a 21% CAGR in earnings per share. Also note that Merck has beaten the street's bottom line estimates every single quarter for the last 5 years, supporting our holistic story. Merck has a strong balance sheet. While its net debt to EBITDA ratio is 1 times, it has a substantial interest coverage ratio of over 19 times, resulting in a strong A1 bond rating. In addition, return on equity increased from 14% in 2016 up to 50%. Combine that with its strong current ratio of 1.32, which is stronger than that of Novartis, AstraZeneca, and GlaxoSmithKline. These numbers demonstrate Merck's effective balance sheet management. Now, Merck's history of operating cash flow is one of consistency in an industry where product lines can lose exclusivity and pricing power. Its strong cash flow displays strength in its operational efficiencies, strategic alliances, and its exceptional portfolio of innovative drugs. Operating cash flow was reported as $6.5 billion for 2017 $10.9 billion for 2018, and $13.4 billion for 2019. This upward trend is very important as operating cash flow is the primary driver of capital financing, CapEx, and dividend payments. Because of its strong cash flow, Merck's board of directors has approved a generous $10 billion share buyback and increased its dividend to 61 cents a share, marking the 9th consecutive year of a dividend increase. In addition, with Merck's dividend yield of 2.9%, it is a reward for waiting for the stock to increase to our $99 price target. And if you consider that the dividend yield on the S&P 500 is only 2.25%, 2.9% looks very attractive. While you're waiting for the capital gain, you can collect that dividend along the way. I'll now turn it over to Stephen to start our valuation.
Thanks, Tim. To begin our valuation methods, we're going to first look at Merck's relative valuation to see how they stack up against their competitors. Holistically viewed, Merck's relative valuation is the most compelling in its class. Its forward PE of 13.9 and PEG ratio of 0.67 are major contributors to its number one ranking. This can be seen in Merck's 5-year total cumulative return against the same peers and S&P 500. Merck's CAGR of 13% is well ahead of its peers at only 9%. In turn, we take our 2020 estimated EPS of $6.21 and multiply it by our forward PE of 13.9, resulting in a price target of $86. Next, in our bull-bear analysis, our most optimistic price sits at $135, with our low price at $65, a very attractive upside to downside. Our bullish stance of $135 is based on an implied EBITDA CAGR of 9.2%. Juxtaposed by our bear case at $65, which is driven by sub-industry growth and an added concern of a recession, our base case fits comfortably right in the middle at $109 based on our free cash flow to equity model. I'll now hand it over to Anders to discuss in more detail our FCFE and some of the parts models.
Thank you, Stephen. We forecast Merck to generate significant cash flow on a 5-year 6.7% top-line CAGR, coupled with a 6.4% EPS CAGR, leading to an implied EBITDA CAGR of 4.6%. Now, as we are only concerned with the equity of Merck, we use a 6.9% CAPM-derived cost of equity based on a bottom-up beta of 0.74. Given its expanding pipeline and optionalities, Merck has constructed a wide economic moat, as free cash flow climbs from $11.2 billion in 2019 to $13.2 billion by 2024. Now, the recent decision by management to spin off a new co only reaffirms our thesis that Merck is being undervalued on a fundamental basis. Through some of the parts model, we identify 3 robust segments that define Merck: pharmaceuticals, vaccines, and animal health, weighting them by their contribution to sales and valuing each using a blended PE of firms in each segment peer group. Now, this results in a $102 price target on $6.21 of EPS using a weighted average 16.5 PE. Checking those results, we ran a sensitivity analysis and a Monte Carlo simulation. Across varying terminal year EPS and cost of equities, our sensitivity analysis indicates a potential upside of $121 to a downside of $67. These results translate to a potential 49% upside to a 19% downside as of April 20th. Our Monte Carlo simulation with 1,000 iterations shows an average price of $105 and a standard deviation of $5.36. Our attractive price target sits within 2 standard deviations of the mean, and we are 95% confident of our results. Merck is showing an attractive valuation. Given that cash is king, our fundamentally grounded free cash flow to equity model is weighted the heaviest. Reinforced using a relative valuation and checked with a sum of the parts model, we arrive at our attractive $99 price target, a 19% upside as of April 20th. And now, Claudia will cover the risks and the final thoughts.
Thank you, Anders. Political pressure and regulatory approval slow time to market. However, Merck has extensive experience in the approval process, mitigating this risk. A second concern is
1 minute remaining.
A second concern is price pressure. However, Merck's rising profit margins suggest it is managing this space well. Gene therapy moves treatment away from drugs. However, it is in its early stages and its efficacy has yet to be demonstrated. Finally, the coronavirus has instilled recessionary fears. However, we do not see the sales of Keytruda and Gardasil being significantly impacted, as sales are not business cycle driven. These risks do not undermine our holistic story that is once again based on 3 pillars of oncology, vaccines, and animal health. Merck's recent announcement they will use these 3 areas to organize its business only further reinforces our conviction and our holistic story. Thank you. We welcome your questions.
Okay, let me start. Thank you for the presentation. So can you describe two major drugs that's basically at the core of your success story. How much of revenue do these two drugs contribute, and how does Merck's drug pipeline look like in the next few years?
Sure, of course. So currently we actually see Keytruda, one of Merck's main products that we keep talking about in the oncology space, currently making up a quarter of their revenues. And that's offset by animal health at 10% and the remainder being all the vaccines and the rest of the products. And we really see in the pipeline in the future years, obviously we have the spin-off coming up, which will change these percentages to a bit higher for Keytruda and animal health and dropping the remainder due to Merck spinning off about half of their products, or around $6.5 billion in revenue. But as far as their product portfolio and pipeline progresses, we definitely see a lot of optionalities derived from Keytruda, and also several vaccines in late stages, phase 3, including a pneumoconjugate vaccine.
So how much of revenues are being impacted? Well, for example, from a cost standpoint, everything is being marketed heavily these days, and especially with advertising. What kind of advertising and marketing budgets are versus R&D budgets are out there?
Well, currently, the R&D for Merck is around $7 billion. And, they do have a very, effective sales force, but, Merck too is more than just Keytruda. Okay, it's Lynparza, it's Lenvima, it's Gardasil, it's animal health, and it's going to be a very, very successful story with their entire innovative portfolifio.
And with regards to their marketing efforts, they actually use in-house marketing, so they have teams that directly sell to physicians and different healthcare systems.
Could you go back on Keytruda and develop more the strategy to improve product diversification and to mitigate the concentration of Keytruda in terms of percentage of revenues?
Yeah, so again, we're not worried about concentration risk with Keytruda. Merck is more than just Keytruda. Again, it's Lynparza, it's Lenvima, it's Gardasil, it's animal health. And now after the spinoff of NewCo, that's going to allow Merck to focus on its core growth drivers, which should bring the whole innovative portfolio up. So again, we're not worried about concentration risk with Keytruda.
Yeah, and Keytruda can also be used in combination with other therapies. So, for example, Merck recently met its endpoint for triple-negative metastatic breast cancer. This was a huge accomplishment, and it just demonstrates that Keytruda alone and in combination.
I think we might be having some technical difficulties. But in the competitive landscape, it's actually been seen that Keytruda is outpacing the competition by a great bit. Trial numbers and current patient outcomes who are using Keytruda as comparative to Opdivo, which is the Bristol-Myers equivalent, are seeing far greater rates of success as compared to that drug. So Keytruda is really a formidable competitor within this space.
That's correct.
This cost-cutting strategy has been very successful for the company, but it's not a long-term strategic strategy. So how more room is there in the future to continue this cost-cutting strategy in order to boost the financial results?
There is still more room. We do even have that forecasted. Merck is continuing cost-cutting measures and manufacturing restructuring. There's AI advancements, and there's still continued cost-cutting throughout the supply chain. So really through 2024, we do expect them to continually be able to cut costs. In addition, Merck's increased margin expansion is really due to two things. It's cutting cost and the success and the growth of Keytruda, which is a very high margin product.
And moving forward, if we analyze, the deal that's taking place with this new code deal, roughly $1.5 billion will be saved annually through SG&A costs. This is basically through the transition. They're moving roughly 10,000 employees over to this new co. So through our calculations, we figure that's where they'll gain the savings. But in addition, we actually see their net debt to EBITDA ratio declining, mainly due to higher EBITDA growth comparatively to net debt, because NewCo will be taking on roughly 40% of the outstanding debt that Merck currently has.
And then the other thing that I'll add, while it expands out to 2024, because of NewCo, it's actually going to reduce Merck's human health manufacturing by 25%, and also the number of products it has by 50%, resulting in a continued more leaner and more efficient operating model.
What kind of competition do they have in some of their mainline drugs like Keytruda? Are there Me Too's coming out there?
Sure. So Keytruda is well positioned against Bristol Myers Opdivo. In 2018, they actually surpassed Opdivo's sales. So in this space, directly with Keytruda, Bristol Myers, it's well positioned against Bristol Myers.
And when we look at other company products, including Roche, who's a very predominant player within the oncology space, they have several different products, including their number one product, Avastin, which handles certain types of cancer. But really the main amazing thing about Keytruda is just all the different 15 plus cancer types that Keytruda actually can be used to treat, and all the different indications that they are still working on discovering and researching currently.
And I'll also add that it does have a very strong patent until 2028. So
yes.
Long story.
And then even looking at animal health, it's a very niche market. It roughly the industry as a whole has a 5% CAGR. Merck is exhibiting 9% CAGRs. And this is mainly due to their aggressive strategy entering into emerging middle markets within the livestock space, primarily with digital technologies, so that farmers are able to track the health of their herds in a greater capacity.
And to expand on the vaccine section, we actually have GlaxoSmithKline's Cervarix vaccine, which is their equivalent to Gardasil 9. However, in prior years, they actually stopped selling this vaccine within the US market. And Merck has even gone on record to say that this is a very difficult vaccine for them to manufacture. So that even extends, while they have their patent protection to 2028, even further out, preventing from generics to come in and undermine them in that space.
Yeah, so this is the wide economic moat we're talking about. You know, we're seeing a lot of success in all three of these key pillars, and they're just going to keep widening it into our forecast.
The bull bear analysis shows an asymmetrical outcome. So could you please elaborate on the assumptions behind these two scenarios, please?
Yes, certainly. So our bull bear was derived through a free cash flow to equity model. Our base case is $109, and this is on fairly decent growth. We didn't want to be aggressive with the base case, as it's based off of a lot of management guidance. We do believe the management, so we took a fairly aggressive estimate, but really our bull case represents the full potential of guidance that Merck can take on. This is represented in the $135 price target. It has very significant margin expansion. It very much goes on in line with what management is portraying Merck will be in the coming years. Now, if we take a look at the bear case, this is on general sub-industry growth. We have a top line 4% growth rate. This is 1% lower than the industry. And we've also added in the possibility of recessionary fears and increased costs due to fallbacks within the R&D process. Still, this comes out to roughly $67, and we don't see this as a great probability, though, as they are very efficient with their research and forecasts.
Yes, I thought that maybe you were considering that because of the monetary policies and the lower trend in interest rates, maybe there was some impact on the weighted average cost of capital. But
so in terms of monetary policies, are you referring to political pressure of a new president and insurance policies in that case?
No, no, I was talking about maybe because of the cost of debt is going down,
Okay.
maybe there would be a boost in terms of the valuation model because of a lower WACC.
You know, so Merck is fairly responsible with their balance sheet. As Tim stated, they have very good metrics describing their liquidity. Time. Okay. Thank you, Judge.
Thank you very much.
Thank you guys very
Yeah.
much. Appreciate it.
All right, thank you, Seton Hall University with a buy on Merck.